The Panic of 1873 was one of the first truly global economic crises and marked the beginning of the Long Depression, a prolonged economic downturn lasting over 2 decades. The panic was triggered by the collapse of J. Cook and Company, a major American bank that had heavily financed railroad construction, seen as the backbone of America's industrial expansion. When the bank went bankrupt in September 1873, it set off a chain reaction of bank failures and stock market crashes in both the United States and Europe, where similar speculative railroad investments had taken place. In the US, the collapse of railroad investments devastated industries that depended on infrastructure expansion, such as steel, coal, and construction, leading to widespread unemployment, factory closures, and business failures. Workers and farmers were especially hard hit, as wages dropped, prices for agricultural products fell, and bank failures wiped out savings. In Europe, economies that had also invested heavily in speculative ventures experienced sharp downturns, worsening political and social tensions, and causing a continental economic crisis. The Long Depression was characterized by deflation, falling commodity prices, reduced industrial production, and persistently high unemployment. The prolonged economic stagnation led to social unrest, including labor strikes, protests, and demands for reform, particularly from the working class. Political shifts toward protectionism and the adoption of trade barriers became widespread as nations sought to protect their struggling economies from foreign competition. The crisis also contributed to a reevaluation of industrial capitalism and the dangers of unchecked speculation, leading to more regulated banking systems and efforts to stabilize international finance. It took years for global economies to recover fully, with some regions suffering into the 1890s. The Panic of 1873 left a lasting legacy on international trade, financial markets, and economic policy, shaping how future crises would be managed and sparking movements for financial reform that influenced the modern banking landscape. The Great Depression remains the most severe economic crash in modern history, with lasting impacts on global economies, politics, and society. It began with the stock market crash of October 29, 1929, Black Tuesday, wiping out billions of dollars in wealth and sending shockwaves worldwide. Bank failures, industrial collapse, and a sharp decline in consumer spending led to 25% unemployment in the U.S. by 1933, with millions facing poverty and food insecurity. Globally, the Depression worsened economic instability, contributing to the rise of totalitarian regimes like Hitler's in Germany. Countries like the United Kingdom, France, and Japan also experienced deep recessions, fueling social unrest and political shifts. In response, U.S. President Franklin D. Roosevelt's New Deal introduced programs like Social Security and public works projects, which helped alleviate the crisis but did not bring full recovery until World War II. Other nations followed with similar interventions, though many remained trapped in economic stagnation throughout the 1930s. The crisis also spurred Keynesian economics, advocating for increased government spending during downturns and stronger financial regulations, such as the FDIC, to prevent future crises. Central banks began playing a more active role in stabilizing markets, and governments became more involved in economic management, marking a turning point in global financial policies. The cultural impact of the Depression was equally significant. In the U.S., literature, photography, and music, such as the folk songs of Woody Guthrie, captured the struggles of ordinary people. Hollywood films offered both escapism and social commentary, reflecting public discontent. Globally, the economic downturn reshaped international trade as countries imposed tariffs to protect domestic industries, further deepening the crisis. Some economies, like the Soviet Union, which was relatively isolated from global markets, saw less severe effects, leading some to view communism as a potential alternative to capitalism. The trauma of the Great Depression left a lasting legacy, with lessons that continue to shape economic policies and debates today. The oil crisis of 1973 began when the Organization of Arab Petroleum Exporting Countries, OAPEC, declared an oil embargo in October 1973 in retaliation for Western support of Israel during the Yom Kippur War. The embargo specifically targeted the US, Japan, and Western Europe, causing the price of oil to quadruple within a few months. This sudden spike in oil prices had catastrophic effects on global economies, particularly in oil-dependent nations, where the price shock severely disrupted industries reliant on cheap energy, such as manufacturing and transportation. The oil embargo triggered stagflation, a crippling combination of stagnant economic growth, rising unemployment, and soaring inflation, which hit the US, Western Europe, and Japan hardest. Industries like manufacturing, transportation, and automobile production, which were heavily reliant on affordable oil, suffered massive financial losses, leading to widespread layoffs, factory closures, and a sharp economic contraction. Consumers faced long lines at gas stations, fuel rationing, and skyrocketing heating and transportation costs, further driving inflation and undermining public confidence in government responses. In response to the crisis, many countries were forced to rethink their energy policies. The oil shock exposed the vulnerability of global economies to energy supply disruptions and led to efforts to diversify energy sources, improve fuel efficiency, and reduce reliance on imported oil. The crisis spurred investments in alternative energy, such as nuclear power and renewable energy technologies, while also encouraging energy conservation measures. Additionally, it saw the creation of strategic petroleum reserves, like the U.S. Strategic Petroleum Reserve, to prevent future supply shocks. The 1973 oil crisis permanently altered the global economic landscape, highlighting the geopolitical power of oil-producing nations and the fragility of industrialized economies dependent on fossil fuels. It also shifted the balance of global politics, empowering OPEC and creating long-term energy security concerns that continue to shape international relations today. The crisis remains a stark reminder of the global economy's vulnerability to external shocks and the importance of sustainable energy strategies to safeguard against future disruptions. The Asian financial crisis began in July 1997 when Thailand was forced to devalue its currency, the baht, after exhausting its foreign exchange reserves, having failed to defend the currency against speculative attacks. This marked the start of a regional financial meltdown. The crisis rapidly spread to other economies in Southeast Asia and East Asia, including South Korea, Indonesia, Malaysia, and the Philippines, which had experienced rapid economic growth fueled by foreign capital inflows and speculative real estate bubbles. These economies had borrowed heavily from abroad to finance expansion, creating dangerous levels of debt that made them vulnerable to external shocks. As investor confidence collapsed, capital flight ensued, triggering sharp declines in stock markets and steep devaluations in local currencies. The ensuing financial panic caused severe economic contractions, plunging millions into poverty. Indonesia, in particular, faced widespread social unrest as soaring unemployment and hyperinflation led to violent protests, ultimately culminating in the ousting of longtime dictator Suharto in 1998 after 31 years in power. South Korea and Thailand also faced deep recessions, while other nations in the region saw their economic gains wiped out nearly overnight. In response, the International Monetary Fund, IMF, stepped in with emergency bailouts for several countries, but these came with strict conditions such as austerity measures, budget cuts, and economic restructuring programs. While intended to stabilize economies, these policies often worsened economic hardship, leading to further social unrest and political instability. The crisis revealed the fragility of rapidly growing economies dependent on short-term foreign investments and under-regulated financial sectors, highlighting the risks of over-leveraging and unchecked speculative growth. This period reshaped the economic policies of many affected nations. Countries moved to adopt stricter financial regulations, increase currency reserves, and embrace more cautious growth strategies to avoid future vulnerabilities. The crisis also underscored the importance of economic transparency and stronger institutional frameworks, both of which were lacking in many of the affected economies at the time. In the years that followed, these reforms helped restore confidence. But the scars of the crisis were felt for decades, particularly in terms of slowed growth and diminished trust in financial institutions. The dot-com bubble of the late 1990s was driven by speculative investments in internet companies, many of which were dramatically overvalued based on unrealistic growth expectations and hype surrounding the rapidly expanding internet sector. As internet usage skyrocketed, venture capitalists and individual investors poured billions into tech startups, often ignoring the lack of sustainable business models or clear paths to profitability. By March 2000, the NASDAQ stock index, heavily weighted toward tech firms, peaked at over 5,000 points, but cracks began to show as investors started realizing that many companies were not living up to their inflated valuations. Over the next 2 years, the market collapsed, losing nearly 80% of its value and wiping out trillions in investments. High-profile failures like Pets.com and Webvan became symbols of the era's excesses, as their unsustainable business models and lack of profitability led to their downfall. The dot-com crash triggered a significant recession in the US, resulting in massive layoffs across the tech industry and a sharp contraction in venture capital funding for new startups. Many companies vanished overnight, unable to secure further investment or generate revenue, creating a ripple effect throughout the tech ecosystem. However, some firms, such as Amazon and Google, managed to survive and eventually emerged as dominant players in the tech industry. These companies focused on robust, scalable business models and long-term growth strategies, allowing them to thrive once the dust settled. The dot-com crash serves as a cautionary tale of speculative bubbles, highlighting the dangers of investing based on hype rather than sound financial fundamentals. It underscored the importance of due diligence in assessing whether companies have sustainable paths to profitability, and shifted future investment focus toward measurable performance and realistic growth expectations, rather than inflated market sentiment. The lessons from this crash reshaped venture capital practices and drove the industry toward more sustainable innovation and cautious investment strategies. Global financial crisis was triggered by the collapse of the US housing bubble and the subsequent failure of financial institutions that were deeply invested in risky mortgage-backed securities. Leading up to the crisis, banks extended subprime loans to homebuyers, many of whom were unable to repay. These loans were bundled into complex financial products and sold to global investors, creating an unsustainable housing market boom. When home prices plummeted and borrowers defaulted on their loans, the entire financial system unraveled, exposing the dangerous interconnections between Wall Street and global markets. The bankruptcy of Lehman Brothers in September 2008 marked a critical turning point, triggering panic and demonstrating the fragility of the global financial sector. The collapse sent global markets into freefall, wiping out trillions in wealth and causing mass unemployment, particularly in the US and Europe. Governments and central banks responded with unprecedented measures, including bailouts for major financial institutions, stimulus packages, and monetary interventions like quantitative easing to inject liquidity into the economy. However, the crisis led to severe austerity measures in many countries, particularly in Europe, where nations like Greece, Spain, and Portugal faced high unemployment rates, economic hardship, and social unrest. The crisis exposed the dangers of deregulation, financial speculation, and inadequate oversight of complex financial products, resulting in the introduction of stricter financial regulations, such as the Dodd-Frank Act in the US, aimed at preventing future collapses. Despite these reforms, the crisis exacerbated income inequality, as corporate bailouts were seen as disproportionately protecting the wealthy, while ordinary citizens faced economic hardship. It significantly weakened public trust in financial institutions and governments, sparking ongoing debates about the role of banks and the need for further government intervention to protect markets and prevent similar economic disasters in the future. The global economy was left deeply scarred, with long-lasting effects on employment, wages, and economic stability, particularly in the Eurozone. Thank you for watching. If you enjoyed this deep dive into history's most devastating economic crashes, don't forget to like, subscribe, and leave a comment with your thoughts or suggestions for future topics.